Imagine waking up, making coffee, unlocking your phone, and seeing a sea of red. The headlines are everywhere. Markets plunge, billions wiped out, panic selling accelerates. Your investment account, which looked healthy yesterday, is suddenly worth far less. Your heart races. You wonder, should I sell? Should I wait? What if this time it's different? For over a century, markets have risen, fallen, recovered, and risen again. Yet every generation believes its own crash is unlike any before. Why? Because market crashes are not only financial events, they are psychological events. They test something deeper than wealth. They test human behavior. Long before smartphones, before financial television, before instant notifications, investors still panicked. News traveled by newspaper, by telegram, by word of mouth, but the emotions were remarkably familiar. Hope, greed, fear, relief. Technology has changed. Human nature hasn't. That's why history often feels surprisingly familiar. Different companies, different decades, the same emotional cycle. Markets rise, optimism grows, confidence becomes certainty. Then, unexpected news arrives, confidence weakens, fear spreads, selling begins. Others see prices falling and join in, not because they understand everything, but because they fear being the last one left. Meet Daniel. Daniel isn't a professional investor. He's an engineer. He invests steadily, month after month, year after year. Then, the market falls 10%, 20%, 30%. Every news broadcast seems darker than the last. Friends begin selling. Social media predicts economic collapse. Daniel checks his account again and again and again. The numbers continue falling. Eventually, fear whispers a dangerous thought. Get out now, before you lose everything. But Daniel faces a question, shared by millions before him. Is he responding to facts or to fear? Why does investing feel so different during a market crash? Behavioral researchers have found that people often experience the pain of losses more intensely than the pleasure of equivalent gains. In other words, losing $100 can feel emotionally stronger than gaining $100 feels rewarding. This tendency can make market declines feel overwhelming, even when they are part of long-term investing. Our brains evolved to respond quickly to threats. That instinct once protected us from danger. Today, it can tempt investors to make permanent decisions based on temporary emotions. Understanding this tendency doesn't eliminate fear, but it can help us recognize it before acting on it. Every market crash tells two stories. One is written in numbers. The other is written inside the human mind. Understanding the first helps us read financial markets. Understanding the second may help us understand ourselves, and that is where our journey continues. Imagine standing in a crowded theater. Someone suddenly shouts, "Fire!" Within seconds, people begin running. Not everyone stops to verify what happened. Many simply react to everyone else. Financial markets can behave in surprisingly similar ways. When prices fall, some investors sell. Others see the selling and assume those investors know something important. More people sell. News coverage intensifies. Social media fills with predictions. Fear spreads, not only through information, but through observation. Psychologists call this herd behavior. Following the crowd can feel safer, but history reminds us the crowd isn't always correct. Sometimes, the loudest emotion isn't the clearest signal. Imagine finding $100. You'd probably smile. Now imagine losing that same $100. For many people, the disappointment feels even stronger than the joy of finding it. Behavioral economists have spent decades studying this tendency. One consistent finding is that losses often feel emotionally more intense than equivalent gains. This doesn't mean investors are irrational. It means we're human. During a market decline, seeing account balances fall can trigger powerful emotions. Those feelings are real, but feelings don't always tell us what the best long-term decision is. One of the greatest challenges in investing is learning to separate temporary emotion from thoughtful planning. Market crashes create headlines. Headlines attract attention. Attention drives conversations. During volatile periods, our minds naturally seek constant updates. We refresh news apps, watch financial television, scroll social media, check our portfolios again and again. Information can be valuable, but too much information, especially during stressful moments, can magnify anxiety without improving decision-making. The challenge isn't staying informed. It's remembering that the loudest headlines often describe the shortest moments. Long-term investing usually unfolds over years, not hours. Many people use the words volatility and risk as though they mean the same thing, but they describe different ideas. Volatility refers to how much prices move over time, sometimes quickly, sometimes dramatically. Risk depends on many factors, including your goals, time horizon, and financial situation. A temporary decline may feel uncomfortable, but discomfort alone doesn't define risk. Understanding the difference helps investors ask better questions, not why is the market moving today, but does this change my long-term plan? Sometimes the answer is yes. Sometimes it isn't. Thoughtful investing begins with knowing the difference. Every market decline tests investors, not only financially, but emotionally. The crowd reacts. The headlines grow louder. Fear feels persuasive. Yet beneath all that noise, another story quietly unfolds. One written not by emotion, but by patience. And that's where our journey goes next. Imagine standing before a mirror, not one that reflects your face, but your emotions. On ordinary days, investing can seem simple. Buy, save, wait. But when markets fall, the mirror changes. It reflects fear, doubt, impatience, regret. Many investors discover something surprising. The greatest challenge isn't understanding the market, it's understanding themselves. Market declines don't create our emotions, they reveal them. And sometimes, the most important investment lesson has very little to do with numbers. A child plants an oak tree. The next morning, nothing appears different. A week later, very little has changed. Even after a year, its growth may seem modest, but decades later, its roots run deep. Its branches offer shade. Its strength becomes obvious. Long-term investing often works the same way. Daily market movements can feel dramatic, yet many long-term goals, such as retirement or education savings, unfold over years or decades, not days. Looking only at today's price can be like judging an oak tree by a single sunrise. Perspective changes everything. Imagine owning a small bakery. One rainy afternoon, fewer customers visit. Sales decline. Would that single day tell you everything about your bakery's future? Probably not. Businesses experience good days and difficult ones. Markets can behave similarly. A market price captures what buyers and sellers agree on. At a particular moment, your financial plan is something different. It reflects your goals, your time horizon, your circumstances. Sometimes, prices change quickly. A thoughtful plan usually changes much more slowly. Successful investing is often less about predicting and more about preparing. No one knows exactly what markets will do next, but many investors focus on what they can control. Saving consistently, keeping costs low, diversifying thoughtfully, reviewing their goals, managing risk in a way that fits their own circumstances. These habits don't eliminate uncertainty, but they can create a framework for making calmer decisions. When uncertainty arrives, a strong process cannot promise a perfect outcome, but it can help reduce the temptation to let fear make every decision. Markets will continue to rise and fall. Headlines will continue to change. Predictions will come and go. But one question remains: when uncertainty arrives, what kind of investor do you want to become? The answer is rarely found in tomorrow's headlines. It is built through the habits you choose today. Imagine opening a history book. Its pages are filled with wars, discoveries, revolutions, economic booms, and market crashes. At the time, each chapter felt overwhelming. People wondered if things would ever feel normal again. Years later, those same moments became history. Every market decline tells two stories. The first is the story of prices. The second is the story of people. Some reacted immediately. Some paused, reviewed their plans, and made deliberate decisions. The numbers eventually became part of history, but the lessons remained. Perhaps the greatest return isn't found inside your portfolio. Perhaps it's found inside you. Patience can be practiced. Discipline can be strengthened. Perspective can be learned. No market can remove those qualities once they've been developed, because true investing isn't only about building wealth. It's about building character, one decision at a time. The next market decline will arrive someday. No one knows exactly when. No one knows exactly why. But uncertainty has always been part of investing. Fear will likely return. Headlines will grow louder. Opinions will multiply. And when that moment comes, perhaps you'll remember that markets don't only test portfolios. They test our perspective, our preparation, our patience. Not every investor will make the same decision, and that's okay. The important question is whether your decisions reflect your own goals rather than someone else's fear. Wisdom isn't the absence of uncertainty. It's learning to think clearly even when uncertainty remains. And perhaps that is the greatest investment any of us can make. Markets will continue to surprise us, but wisdom doesn't come from predicting every surprise. It comes from preparing for uncertainty with patience, discipline, and perspective. I'm Lily, and this is Lily Invests, where markets are explained beautifully so wisdom can compound for a lifetime. Until next time, keep learning, keep growing, and invest with understanding.